All right, let's talk Viemed Healthcare. They just dropped a record-breaking quarter, so why on earth did Wall Street send the stock tumbling? It doesn't quite add up, right? Well, we're going to dig into their Q3 2025 earnings and figure out exactly what's going on. Let's get into it.
So, look at this. On one hand, you've got a fantastic quarter. Record revenue of $71.9 million. That's a 24% jump from last year. Just incredible. But on the other hand, the stock gets punished, closing down 2.6%. This is the central puzzle we're here to solve. Why would the market react so poorly to what looks like a home run?
Okay, to get to the bottom of this, we have to do what the pros do. Look right past that big, flashy headline number. The market is obsessed with the tiny details, the fine print. And that's exactly where we're going to find the cracks in this story.
And boom, here's problem number one. Earnings per share, 9 cents. Now that might not sound bad, but it was a penny short of what Wall Street analysts were forecasting. And let me tell you, in a jumpy market like this one, even a tiny miss like that can totally spook investors. It's often enough to trigger a wave of automated selling.
All right, the second red flag for investors was the gross margin. It clocked in at 57.5%. Now, if you followed Viemed for a while, you know they usually live in that 59 to 60% range. So this dip, it's not just a number. It signals a real fundamental shift in the business. And now you've got investors asking the big question, can Viemed still be as profitable as it used to be?
But hold on, the margin story isn't all doom and gloom, not at all. Yeah, gross margin is getting squeezed a bit, but check this out. The company is showing some real operating leverage. Their overhead costs, SG&A, as a piece of their total revenue actually got better by 160 basis points compared to last year. That's a huge sign of efficiency as they get bigger, and it's a key positive that it feels like the market completely glossed over.
Now, you might think management will be panicking about this, but they weren't surprised by these numbers at all. In fact, if you listen to the call, these changing margins are actually a core part of their game plan. It's all about their big strategy, transforming Viemed into a much more diversified healthcare company.
And this quote from the CEO, Casey Hoyt, really just says it all. He points out that for the first time in over a decade, their core ventilation business, the high-margin stuff that built the company, is now less than half of their revenue. And get this, it's not because that business is shrinking. Nope, it's because their other newer business lines are growing so much faster.
This chart just illustrates the new Viemed perfectly. Ventilation is now under 50% of the pie. The real story here is the incredible rise of everything else. Sleep and resupply, that's a quarter of the whole company now. Plus, they've bolted on a staffing business and a brand new maternal health division. This is a very deliberate, very strategic pivot away from being just a one-trick pony. And when I say growth, I mean explosive growth. Just look at the new patient starts for their sleep therapy business, up a staggering 96% year over year. Come on. This is the company's new engine, and it is absolutely firing on all cylinders. This is what's driving that record-breaking revenue we saw at the start.
Management also made a huge point of this on the call. This new business mix is a total cash flow machine. We're talking over $12 million in free cash flow in this quarter alone. And what does that do? It gives them a ton of flexibility to do things like acquire other companies and, maybe more importantly, to aggressively buy back their own stock.
Okay, so that's management's side of the story. It's a compelling long-term plan, right? But that brings us back to the big question. Why is the market slapping such a heavy discount on this stock right now?
And just to be clear, this isn't some one-day fluke. Viemed has been a massive laggard for a while. Over the past year, the stock is down almost 30%. Meanwhile, the broader healthcare sector is up 9%. That is just a brutal, brutal divergence.
So what we have here are two completely different stories clashing. You've got the market totally fixated on the short-term stuff, that tiny EPS miss, the squeezed margins, and the fact that it's in a pretty unloved part of the market right now. But then you have management, who's trying to tell this sweeping, long-term story of strategic diversification, explosive growth, and just powerful cash flow. So, where do we come down on all this? Well, it's time for the next call, where we give you our verdict on what to expect from here.
Okay, first off, our prediction. That margin pressure, it's going to stick around for a bit. You can't have your lower margin sleep business growing at nearly 100% without it weighing on the overall company average. It's just math. Second, price action. We expect the stock to basically trade sideways, to be range-bound, Why? Because the market needs to see more proof that this whole transformation is actually working. And the really big catalysts, they're probably still a year or so away. So for all those reasons, we are assigning a market perform rating.
And just so we're all on the same page, what does market perform mean? It means we expect Viemed stock to pretty much track the broader healthcare market, think the XLV ETF, over the next 12 months. We just don't see a huge catalyst for it to break out and outperform until Wall Street gets a lot more comfortable with this new business mix.
But listen, a market perform rating doesn't mean there isn't a really interesting trade to be made here. And that brings us to our final segment, the trade idea. Of course, you know the drill. This is not financial advice.
So the trade idea here is a classic pairs trade, a relative value play. You go long Viemed stock, and at the same time, you short the healthcare sector ETF, the XLV. What's the thinking? Well, it's a bet that Viemed, this high-growth, cash-gushing business, will eventually get the respect it deserves for its fundamentals, and that it will outperform its more sluggish peers. It's a direct play to capture that massive valuation gap we showed you earlier.
So, we'll leave you with this final question to chew on. Is the market so zoomed in on a one-penny earnings miss that it's completely blind to a really high-quality transformation story hiding in plain sight? That's the bet. And one last time, this is not financial advice.